Welcome to fall. September is my favorite month of the year, but not my favorite month to be an investor. It's hard to believe September is the only month of the year with a higher frequency of negative returns than positive returns since 1928. It's kind of mind-blowing to think about. It just goes to show that it pays to be a long-term investor. Zooming out, year-to-date performance is definitely a welcome reprieve from 2022. Year-to-date, the S&P 500 is up 16.5%, the Dow Jones Industrial Average is up 4.5%, and the NASDAQ is up a whopping 32%. Looking a bit beneath the surface reveals that most of the performance in the market has been driven by the top 7 stocks: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. After a strong first half of the year, we've plateaued since mid-July. But consolidating after establishing a new bull market is a normal part of investing. So where does that leave us?
We continue to believe a soft landing is possible, and actually now believe it's the more probable scenario. Last week's CPI and PPI report aside, inflation has slowed sharply, and we believe that the Fed is well on track to achieve their goal of 2% inflation. CPI for August came in at 3.7% year over year, slightly higher than the estimates of 3.6%. However, most of the increase was due to housing and shelter costs, and services came in softer than expected. Shelter and housing make up 35% of CPI, so its trend is important when gauging the overall trend of inflation. The Federal Reserve calculates rent increases differently than the private sector studies, and the latter tend to be more real-time. The correlation between the Federal Reserve's calculations and the private sector calculations, for example, the Zillow Rent Index, is quite close, but the Fed's calculation lags real-time data. So why does this matter? It matters because we can look at private sector data to better understand what shelter price data will look like in future CPI reports. This all sounds good for a soft landing, but you might be thinking, what about the labor strikes we've been hearing about? That can't be good. Well, the effect of a settlement between automakers and the United Auto Workers Union will have less impact on the broader economy than it would have years ago. Why is this? Well, it's because jobs in the US have shifted from manufacturing to services. Since 1950, manufacturing jobs have declined from just under 40% to less than 15% today.
Moving back to the market, we think equities are fairly priced. Not expensive, but not cheap either. The current S&P 500 price-to-earnings multiple, or PE, of 19 times also appears reasonable in the context of our outlook on the economy and inflation. As a reminder, the PE ratio tells us what the market is willing to pay for a stock today based on future earnings. In short, we do not believe the US is going to fall into a meaningful recession, and we believe the Fed is finally getting inflation under control. The absolute 12-month forward PE ratio of 19 times ranks in the 87th percentile versus historic averages. Excluding the previously mentioned 7 largest stocks in the market, the forward PE ratio equals 17 times, which is in line with the 10-year median and 8% below the pre-pandemic peak of 19 times. So what does all this mean? It means there is room for the other 493 stocks in the S&P 500 to have some valuation expansion, which should be supportive of medium-term price appreciation in the index.
Looking at the short term, we think it'll be bumpy in the next month or so. Why? Historically speaking, September is the worst month of returns in the S&P 500. October is historically the most volatile month for the S&P 500. Volatility doesn't necessarily mean negative returns. So if you go back to 1945, the month of October has, on average, gained almost 1%. We think that economic growth may very well slow over the short term due to the resumption of student loan payments and the impact of higher mortgage rates on the housing market. So much like we saw in September, it's very possible to see monthly CPI re-accelerate in the short term before continuing its downward trajectory. Just remember that it's never in a straight line. While we don't expect the same type of major gains that we saw in the first half of the year, ultimately, we do think that we end the year higher. As we look to 2024, we believe that the trough in earnings is behind us, and we expect to see much healthier earnings growth ahead, which should help boost the equity markets in the later months of 2023 and early into 2024. Also, it's hard not to mention that for the first time in over a decade, consumers can earn a meaningful return on their cash. So high cash levels have historically been a bullish indicator for equity markets because they represent future buying power. So in summary, we're optimistic going into the end of 2023 and early 2024 for both equity and fixed income markets. At this time, as we favor a diversified and balanced equity allocation, especially given the valuation discount on the other 493 names in the S&P 500. We are looking forward to closing out the year, and as always, we are here with any questions or if there's anything on your mind that you'd like to discuss. Please let us know if there's absolutely anything we can be doing for you and your family.